evening. 2026 has begun with markets at an interesting crossroads. On one hand, we have strong domestic participation, improving earnings visibility, and expectation that global money could come back into the emerging markets like India. On the other hand, valuation in parts of the market looks stretched. Now, global uncertainty hasn't completely gone away. In fact, we just got one more news at the beginning of this year, and retail investors are asking one basic question. Is this the right time to take risk or the right time to be cautious? So today we break this down with someone who has seen multiple market cycles, managed money through bull and bear phases, and is known for taking clear, data-driven calls. Joining me is Dinshaw Irani, Managing Director and CEO of Helios Capital. Dinshaw, hi. Welcome to the show and a very happy 2026 to you. And before we get into sectors and stocks, let me start very simple. If you had to describe the Indian equity market in 2026 using just one word, what would that be and why?
So thank you first, Kavita, for having me on your show, and a very good, very happy and prosperous New Year to all you and your viewers. So here's how it is. If you were to ask me to describe the market in one word, I think I'll take the most hit movie of last year and going into this year also. And by the way, that movie has yet to release its part 2, so that's how this market can be described as. I think it'll be Dhurandhar. Because I think India, though it was one of the worst performing markets last year, this year I have no doubt, and this is the EM world, I'm talking the emerging markets world. I mean, if you were to break down the index, MSCI EM index, there are around 24 odd countries out there. India was, I think, the 20th worst performing market in that 24 of those countries. And obviously our underperformance was 28 odd % in dollar terms for the full calendar year of CY25. If one were to see the prior underperformance, whenever India has underperformed, the outperformance has been very humongous. By the way, this 28% underperformance has been a historic low. I've never seen that kind of underperformance ever. Even in phases of the index, I haven't seen it so bad. So I have no doubt in my mind that 26 will definitely be far, far better than 25, which is not much to write about, because if you look at 25, we are up only 3 odd % in dollar terms. I'm talking about the MSCI EM index as such, India index as such. And the whole MSCI world was up, world was up 31%. So that's why they're in 28% underperformance. And all this is based on the fact that not only in the underperformance, but in terms of valuations, we are back to our averages of last 10, 15 years. In terms of premiums, we are back to our average premiums. We had shot up to 100% plus premium over the averages as such in the previous year as such. So I think looking at that and the fact that the earnings growth is back in place. By the way, September was the first quarter when one saw upgrades in the MSCI EM index and stuff like that. So I think I have no doubt in my mind that 26 will be better than 25 going forward.
What factors, according to you, are going to write this growth story or maybe take the growth story ahead? Definitely, we are talking about India's earnings story being one of the crucial factors out here.
Yeah, so basically, if you see the degrowth that started last year, was all a culmination of the fiscal tightening and the monetary tightening that the Government of India and RBI undertook in 24. In fact, started off sometime in 23 and continued into 24 as such. That impacted the earnings growth, and mostly so for the small and mid-cap segment, because there the growth was fairly lower, and that's why the degrowth started happening in that segment. And rightly so also, that tightening was needed because inflation was rearing its head at that point in time, and that's why the tightening was needed. But by the end of CY24, I think both the Government of India and RBI realized that they had overdone the tightening, and as a result, the degrowth that hit the Indian economy, rather earnings growth. The economy still continued in its merry pace because of the capex cycle kicking in. But I think mainly the consumption cycle went down, and that is what worried both of them. And that's why they came up with measures which was both on the fiscal and monetary front. RBI started off by cutting interest rates, leaving out liquidity, throwing back liquidity in the system, buying dollars and selling rupees and stuff like that. So, and that's why the rupee has suffered, by the way. So that aggressiveness RBI showed. Government on its part started by in the budget of Feb of last year. They came up with that slabs increase from 7 lakhs to 12 lakhs for income tax exemptions. And plus, they followed up with a GST rationalization. I think that was the final move by the government, which pushed the consumer back into the system. And as a result, September numbers were very exciting. In fact, if you overall numbers were not that great, because I think NSE 500, if you look at just the NSE 500, which is the broadest index that India has to offer, had a earnings growth of 15%. But if you were by the way, that 15% was on the back of a 8% negative growth. So it wasn't a great quarter to talk about. But basically, we came back to the same earnings of September of 23. That's how it was, right? But if you were to break that up, the large cap universe of 100 stocks grew only at 10%. And why? Because large cap never saw a big fall in that whole debacle that happened. But the mid cap in the universe of 150 stocks grew their earnings at 25%. The small cap universe of 250 stocks grew their earning at 37%. So obviously, where the fall was more, the earnings growth was also more. So I have no doubt that this is the segment which will lead the pack going forward in terms of not only earning growth, but also in terms of the returns.
Let's talk about your status on mid cap and small cap. You're always more constructive in these two spaces. But then, as compared to last year, what's the situation now? What's the status now? What has changed fundamentally? Is it earnings we're talking about, balance sheets, or simply valuations becoming more reasonable?
So all of this put together, Kavita, in fact, you hit the nail on the head by kitchen sinking the whole issue. So basically the mid and small cap, by the way, actually valuations, if I talk about standalone, will not make sense, because if I tell you that there are two stocks with 20% growth each, at 20 PEs each, but one is growing at 5%, the other one is growing at 20%, you'll definitely be able to make out that the guy going at 20%, the stock going at 20% with a PE of 20 is much cheaper than the other one, right? So that's where the whole difference happens out here. When the growth rate kicked in, the earnings growth for the mid and small cap was far greater than that for the large cap universe. Though on PE basis, the large cap looks cheap because the PEs are some 18, 19 odd percent, 19 odd times, but the earnings growth is just 10, 11%. So your PEG, now when you discount the PEs for the growth, the PEG works out to almost 2 times, right? But then you come to a mid cap segment where the PE is probably at 25 times, but the growth rate is roughly around, the PE is around 30 times, but the growth rate is around 22, 23%. Now the PEG is 1.5. And then you come to the small cap segment where the growth is probably at, the PE rather is probably at 25, mid-20s, 25 times if I remember right. But the growth rates are 23, 24%. Now the PEG is almost 1. So basically on that basis, on the growth basis and on the valuation basis, the small cap looks the most attractive. The mid cap looks the second best. And obviously the large cap is only for the ones who want to be in safety zone rather than be a bit aggressive on returns.
So now when retail investors hear this, specifically talking about mid-cap and small caps and your status there, what should they not misunderstand about mid-caps in 2026?
So basically, it's not that the rising tide is going to raise all boats. One has to be very selective out here. In fact, if you look at our portfolio of mid-cap and the small-cap fund that we have, you'll see that we have been very selective in our picks. We have not picked out the heavily valued companies, the high PE companies. We've been very selective here in the sense also that we didn't get carried away purely by growth, because one thing that one has to be very clear about in the mid and small cap universe is that quality is paramount out here. Quality of not only management, but quality of accounting, quality of corporate governance, because that all can just take the growth away if that is not there. So that's why we've been very selective, and and that has helped because, if you look at our philosophy itself, which is called elimination investing, these are the factors that we look at while eliminating the companies. We don't select companies, we eliminate first. Whatever pool is left is what we select from that pool. And that is how we built up our portfolio. So one has to be very selective out here.
So what sectors are we talking about? Which 2 or 3 sectors do you believe have both growth visibility and reasonable valuations in 2026 then?
So basically, Kavita, I think the India story will be led by the India consumption story. We have no doubt in our mind, and that excitement comes from the fact that the pre-millennials. So if you look at the labor pool today in India, the pre-millennials, which is the people born before 80s, are just a minor lot now. It's around 28, 29% odd. And the post-millennials are roughly around 70 odd percent of the labor pool. However, the bigger excitement is that the Generation Z is roughly around 38% of that pool. Now, why I'm specifically mentioning Generation Z is because they're very aggressive spenders. They're educated, highly educated people. They're aggressive spenders. They don't mind doing leveraging to spend more money. That gives you that velocity of money, which every economy craves for. I think if that kicks in, I have no doubt in my mind that India will be at the same growth phase where China was in the mid 2010s as such. That's when the pickup really happened. And we are rightly placed so also for that. So our feeling is that it's only domestic growth-driven stories, consumption-driven stories, and that could be not only discretionary spends, but it could be hospitality, tourism, it could be healthcare, or it could be insurance. BFSI, in fact, is a very, and all domestic facing, or rather consumption facing BFSI, private sector banks and all, and NBFCs which cater to consumption. I think these are the stories that one is to play out with, and they'll be the growth leaders going forward.
All right. I just want to do a small rapid fire with you also. I have more questions, but then I'm just tempted to do this first. So, quick answers. One sector you like most for the next 12 months?
BFSI.
One area you would avoid right now, like clear-cut avoid?
Information technology, IT services.
SIP or lump sum in early 2026?
I would say go with lump sum, then follow up with SIP.
One mistake retail investors must avoid this year?
Rising tides do not raise all boats. So don't just get into a sector just because the sector looks good. Be very selective.
Okay. I do have more questions for you, but then my time is up on this particular edition. But thank you so much for taking time out today and helping our viewers navigate, this exciting year, and more to come and more to understand from you later. Thank you so much for being on this show today. Thanks, Insha.
Thank you, Kavita. Always a pleasure.
And with that, it's time for a short break on the Money Show as well. But then we'll be right back with more updates on your portfolio as well. In fact, we'll be doing your live financial planning on the show after this break.